Hello and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Today, we are diving into a fascinating aspect of the financial markets: investor sentiment. It is not just about numbers and charts. The collective mood of investors plays a huge role. But is understanding this mood an advantage or a trap? Imagine an investor, let us call him Alex. Alex saw the Fear and Greed Index hit extreme greed during the dot-com bubble. He jumped in, only to see his investments plummet when the bubble burst. He swore off sentiment indicators. Then, during the 2008 crisis, the same index screamed extreme fear. Alex remembered Warren Buffett is famous, quote, "Be fearful when others are greedy, and greedy when others are fearful." He hesitated, missed a huge buying opportunity, and felt confused. Did you know that a significant percentage of investment decisions are driven by emotion rather than logic? It is a well-documented phenomenon. So are we letting the crowd as emotions steer our financial ship? How can we recognize and wisely use these psychological signals without falling prey to them? That is what we are here to explore. The dot-com bubble is a classic example of market euphoria, extreme greed, leading to a painful crash. Many learned the hard way. So, what exactly are market sentiment indicators? In simple terms, they are tools designed to measure the overall emotional temperature of investors. Are they scared, greedy, optimistic, or pessimistic? These indicators attempt to quantify these elusive psychological factors, hoping to predict potential market trends. They exist because, as Burton G. Malkiel noted in A Random Walk Down Wall Street, psychology, not always rationality, often drives the market. We can broadly categorize them. Some are based on surveys of investor opinions, others look at trading volumes or price volatility. Each tries to capture a different facet of the collective investor psyche. Think of the VIX, often called the Fear Index, which measures expected volatility, or the put/call ratio, which compares bearish bets versus bullish bets. And of course, the Fear and Greed Index, which combines multiple measures. It is a common saying in finance that the market is driven by two emotions, fear and greed. Understanding this is key, but it is not always straightforward. Why is that? Well, one major challenge is that these indicators can be noisy and prone to false signals. Crowd sentiment is fickle and can shift rapidly, especially in volatile markets. What looks like a clear buy signal might be a trap. Then there's the issue of lag. Many sentiment indicators reflect what has already happened, not necessarily what is about to happen. By the time you get a strong signal, the big move might already be over. Herding behavior is another factor. If too many people watch the same indicator and act on it, they can create a self-fulfilling prophecy. But these moves are often not sustainable if not backed by fundamentals. Also, human emotion is incredibly complex. Trying to precisely quantify it with numbers will always involve some degree of error or oversimplification. It is an art as much as a science. And finally, these tools can be misused or misunderstood. New investors especially might see them as a crystal ball, a holy grail, without combining them with other forms of analysis like fundamental research. John Maynard Keynes famously said, "The market can remain irrational longer than you can remain solvent." This highlights the danger of blindly following an irrational crowd sentiment, even if an indicator points that way. Consider an investor who diligently tracks the Fear and Greed Index. It hits extreme fear, so they buy. But the market keeps falling due to worsening economic fundamentals that the sentiment indicator did not fully capture. Conversely, when the index shows extreme greed, they sell, only to miss out on a prolonged rally driven by genuine innovation or economic recovery. It is a tricky balance, isn't it? So why are we so easily swayed by these sentiment indicators? And why do they have these inherent limitations? Part of it is our human survival instinct. As Anthony Robbins mentions in Money Master the Game, our brains are wired to panic during market crashes. This is an unfortunate side effect of our survival mechanisms. We naturally seek safety in numbers, following the herd. This can be beneficial in some life situations, but often detrimental in investing. A lack of deep knowledge and experience also plays a role. Newer investors are often more susceptible to swings in sentiment and look for quick tips rather than engaging in thorough analysis. The media and social media amplify this. News headlines and online chatter can inflate market emotions, directly impacting sentiment indicators and creating feedback loops of FOMO, the fear of missing out, or FUD, fear, uncertainty, and doubt. Furthermore, the market is an incredibly complex system. Prices reflect not just sentiment, but also macroeconomic factors, company news, large institutional fund flows, and global events. Sentiment is just one piece of a giant puzzle. And there is the concept of market efficiency. To a degree, as Burton G. Malkiel argues, markets tend to react quickly to new information, making it difficult to consistently profit from patterns, including those from sentiment indicators, in the long run. Anthony Robbins and Peter Malloch, in Money Master the Game, emphasize the difference between short-term speculation and long-term investing. Relying heavily on short-term sentiment can be more like speculating. Do you agree? The stories of FOMO and FUD spreading like wildfire on investment forums are common. Many make decisions based purely on these emotions, often with regrettable outcomes. It is a powerful force. So how can we use sentiment indicators effectively and avoid their pitfalls? The first key is to combine them with diverse analytical tools. Never rely on a single indicator in isolation. Always use sentiment indicators as a supplementary tool. Cross-reference them with fundamental analysis, understanding the company's health and valuation, and technical analysis, looking at price trends and volume. For example, if the VIX spikes, indicating high fear, don't just react. Investigate if there is genuinely negative news impacting market fundamentals, or if it is just an overreaction. Context is crucial. Secondly, understand the market context and the nature of each specific indicator. Every indicator is calculated differently and has its own nuances. They work best under certain market conditions. The mantra "buy when others are fearful, sell when others are greedy" cannot be applied mechanically. A high put/call ratio might indicate pessimism, but in a strong downtrend, it could just be confirming the trend rather than signaling an imminent reversal. The third and perhaps most crucial point: build a long-term investment strategy and stick to it with discipline. Having a clear plan focused on your long-term goals helps you stay grounded amidst short-term psychological swings. As Brian Tracy advises in his work on personal finance, do not try to buy at the bottom and sell at the top. That is nearly impossible. Instead, be disciplined with your strategy. What does your long-term strategy look like? A value investor, for instance, focuses on buying good companies at reasonable prices, regardless of current market sentiment, as long as the company's fundamentals remain solid. Their anchor is value, not fleeting emotions. Peter Malloch, in Money Master the Game, says, "The best way to handle market turmoil and the fears it can trigger is to be prepared for it." This preparation comes from a solid plan. Think about Warren Buffett. He often buys aggressively when the market panics. This is because he finds great businesses undervalued due to widespread fear, not because he solely relies on a fear index. He combines sentiment with deep, fundamental analysis. In essence, market sentiment indicators are useful tools, but they are not a magic wand. They reflect the market's mood, which can be insightful but also misleading if taken as gospel. The real foundation for sustainable investment success lies in your own knowledge, critical thinking, emotional discipline, and a robust long-term strategy. These are your best allies. Do not fear the market or its emotional swings. Instead, strive to understand it, including its psychological dimensions. This understanding empowers you to navigate, not be navigated by, market sentiment. As Benjamin Franklin wisely said, an investment in knowledge pays the best interest. This is especially true when it comes to understanding the forces that shape financial markets and our reactions to them. Instead of trying to time peaks and troughs based on crowd emotion, focus on building a diversified portfolio that aligns with your risk tolerance and long-term financial goals. This is the path to more confident investing. I encourage you to learn more about some common sentiment indicators, but always approach them with a healthy dose of skepticism and as part of a broader toolkit. How might this change your approach? Take a moment to reflect on your recent investment decisions. Were any of them significantly influenced by market hype or fear, rather than by your own thorough analysis and strategy? It is a valuable exercise. By mastering your emotions and deepening your understanding of market dynamics, you become a wiser, more confident investor, well-equipped for your financial journey. You are in control. Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.